And here you go.
Great. Thank you very much, Sean. Thank you very much, everyone. What a special group today is. This is wonderful to have some of our old friends joining us. So, um, what I'd like to talk about, we are starting the earnings season, and I thought it might be timely to use some of our option strategies to take advantage of the upcoming earnings. And as you know, all the companies they have four earnings a year, and usually used to be really squeezing 1, 2, or 3 weeks, and now they have expanded more. But there's a lot of opportunities if you can take advantage of the strategies to become profitable. Hopefully, after the end of this class, you might have more clarity of um, some of the uh, option strategies we could use to take advantage of, again, the movements before, during, and after these options strategies. Now, one of the things that happened is when we talk about options and when we talk about earnings, a lot of people think of, well, we have to be having a bias. So usually, obviously, in the markets, when things happen, we either bullish, we feel positive about a company, we are bearish, we feel negative, and there are times that we are neutral. The problem is a lot of times we don't like to be neutral. We feel, oh, that's boring. We always feel like we have to have a bias to feel successful. And there's no other season than earnings season when that human psychology comes into the picture, and it feels like, oh, these are the earnings coming up, so um, it's a home run time. This is a lottery time. I'm gonna go out. I'm very bullish about this company, and let's. The best thing would be I buy, call options, and basically sometimes, a lot of times with the technology stocks, people go out buy really out of money uh, call options and thinking that, well, if it works well, they're going to have a big home run and a big profitable day. The thing is, when we talk about options strategies, and that's the reason I really like options, even more so than stocks. I enjoy commodities and futures, but options, they do have a foundation, and it's mostly on a mathematical basis. So if you can have a hang of those fundamental understandings, you can become very successful. And unfortunately, a lot of, again, I mentioned option traders, they look at option playing more of a gambling, and they think it's like throwing darts. And if it hits, well, the profits will be great. And if it doesn't, well, they know, well, they will lose. Unfortunately, they don't have a good understanding of what is really strategies that we have to focus on. I give you one example. For instance, Netflix had their earnings yesterday after the closing. So, the majority of time, I mean, we can come with a bias and say, listen, Netflix, it was really, as you can see, it has been in a squeeze. So, you might not have any directional bias, but then say, oh, it's Netflix, so I'm going to go buy a call option. And you can do a little more investigation if you are thinking just directional. What you could have done, you could have gone back and look at, for instance, the the fourth quarter of last year, for instance, what happened in January of 2020, what happened in January of 2019, what happened in 2018. So based on history, and again, by looking at the charts, looking at the squeeze, you might have developed a little bias as far as the behavior of Netflix in the past three, not the quarters, but again, we go with seasonality, the past fourth quarters of the past 3 years. And based on that, you could have had a little bias and say, well, maybe I should be a little more bullish because every time what they had done, at those 3 times, the stocks had gone up. And the odds could be on in my favor. But as you know, with the earnings, is really you never know what is the outcome, because what happens is you can see that the company can come up with the greatest results, and but during the conference call, things can go the other way. So it is really, it's nothing is 100%. So what I'm gonna try to hopefully clarify in the next 45 minutes is it's not all about having the bias and just buying a call options. There are many other strategies, and I'm going to try to go to few of them. And it doesn't even have to be bias oriented. A lot of things in options are dependent on the volatility, implied volatility, on the standard expected move, on the deltas, the probabilities. And that's what makes the options investing so attractive, because it's based on probabilities. So I go back to, again, Netflix. You can see this was today. And what I could go back, let's say this is from Thinkorswim, I could also go back and look at their earnings. This was from yesterday before the earnings came out. I want to see how they behaved every single quarter price-wise. But also, this is very interesting to see what happened to the implied volatility, what happened up to that moment. And then you can see this reddish color is the implied volatility. And by noticing every single quarter, you can see the collapse or the crash of the implied volatility. You can also look at the money straddles, which again, I hope you have a little foundation. I will refer you to some of my other YouTube classes so you can understand. We've talked about straddles is basically based on volatility. You're buying the call and put, or you can sell. It's really talks about the collapse of, or basically contractions or expansion of volatility. That's when we use straddle. And then you can see what happened in the past. Did they, for instance, this is from the fourth quarter of 2020, well, 2019, but January of 2020, you can see that actual earning beat what was anticipated, and what happened to the stock, and again, what happened to the volatility. So basically what you want to do is, one of the reasons when we talk about profitabilities, a lot of times you say, well, we don't have, for instance, candidates for our option strategy. Well, this is a good season. Now you have the earnings. For instance, every week, as you know, I look at some of the most anticipated earnings. And what we look at is, for instance, this is today, after hours, before hours. Tomorrow we have after hours, we have Intel and IBM. So there are always something that you can actually take advantage of and study on your own. Now, on top of that, we can rank them based on their implied volatility. So what I'm going to try to emphasize today is, if you want to be a successful option trader, you don't really have to understand completely the stocks. It's good to know the big market. You have to understand the markets. The most important things you have to know is the implied volatility. You have to understand the delta, and more than anything else is the expected move. And we will go one by one about them. If you have a good understanding, a foundation of these things, then investing in options becomes, actually, it starts making sense, because now you have a reason. It's not something that CNBC gave you the clue or the hint or the suggestions, recommendations. Oh, go buy this, and you don't know why. Just basically they're suggesting it. Maybe they have an option hour. They suggest. Here you understand how these options move, and you have to remember there are billions of dollars being traded. So this is real money. The option makers are in the business of making money. So they're going to look at this very carefully. So this is not a random event when it comes to the options. So one of the things you have to understand, we've talked about like creeks, is the delta. And why delta is important is because it tells you a couple of things. Number one, what the movement of option is translated by using the delta. So if $1 of stock goes up or down, the movement in the stock is explained by delta. For instance, if there is a delta of 80 in an option, then a $1 move in the stocks will translate to 80 cents in the option. So that's why you can see some options, they go up more, and some options they don't go as much, although the stock moved the same direction. So the higher deltas, that means the more movement in the option. Also, the second thing, which is very important, and that's what we emphasize a lot, is the probability. So delta tells us what is the probability of this option being in the money at the time of exercise or the expiration. I mean, at expiration. So if there's a delta is 80, then there's an 80% chance that our option at that strike price is going to be in the money. Another way of looking at options is, let's say, especially we do a lot of selling options, when you have a delta of 5, basically that means there's a 95% chance that your option is going to expire worthless, which is great. So that 95% translates to 2 standard deviation. If you remember that one standard deviation contains 68.2% of the price range, 2 standard deviation is 95%. So by just understanding that, you know, with a delta of 5, there's a 95% chance you're gonna win on your trading. If there is a delta of 30, which is about 70, then that's 68.2%. That's 1 standard deviation. Delta of 15 will be something in between 1.5 standard deviation. The second thing you have to understand is that implied volatility. And I just showed you what happens, for instance, with when the earnings are coming, usually about 2 weeks before the earnings numbers coming out, the volatility start increasing, the implied volatility. And as soon as the earning has come out, that implied volatility crashes, or in this case, collapses. So it is important to understand what is implied volatility and how you can take advantage of it. So implied volatility goes up till the earning. As soon as earning comes out, it crashes. And why is that? Is the uncertainty, right? So when we don't know what is the outcome, obviously the chances, the range becomes more and more, and that's how the volatility comes into the picture. So how are we going to, based on our strategy, let's see how we can take advantage of that. And this is how, in just putting it visually, let's say it's 2 weeks to 10 days out, this is what happens to implied volatility. And as soon as the earning is released, then you can see there's a collapse. So again, once we talk about earnings options strategies, it's not just all about, oh, something's going to go up or something's going to go down. Actually, you will make a lot more money by understanding the implied volatility and expected move, and try to use the strategies based on that. In this situation, we just talked about Netflix. And as you can see, I took a picture. This is right before the earnings, what Netflix was. And this is from Thinkorswim option pane. And this is the Friday's expiration. And this is yesterday, right before the earnings came. As you can see, the implied volatility is at about 82%. The expected move was about $33. At the time, that was about $502. Just by looking at this, as you can see, it was 82. But when I go out to farther dates, and for instance, we go to February, immediately your eyes can see that the volatility, implied volatility, is actually going down. So in reality, again, we got some certainty once the earning comes out. So the week after, in this case, January 29th, now the volatility is collapsing. And it happens to a lot of different holdings and stocks. So another interesting thing is Netflix has been, we've looked at, it's been in a squeeze. It has been very not much moving. While NASDAQ has been going up, Netflix has been pretty quiet. And so it's important to look at the implied volatilities where it was ranked yesterday, for instance, compared to itself in 52 weeks, highest being 100, lowest being 0. So it has been in the 21%. So it has been the lower end. It has been quiet. So But this is important. That's why, you know, it, I've said it before, it's you, the options allow you to become a really active investor or trader. It puts the responsibility on you. You have to do some work. It's not going to be random. It's not going to be something that you leave it to a chance. And the more understanding you have of the probabilities and numbers, the more successful you will be, because you understand the outcome, you understand the risk, you understand what are the timing, and each one of them, they give you, first of all, accountability, but also they allow you to um, plan your trade ahead of time. And that's why it's important to, I said it, write down in your journal to understand why you're doing this. It's not, with the individual stocks, we've talked about, there's a lot of things can go wrong. The CEO can do something. There could be a lawsuit happening. There's a lot of different things can affect stocks. But with options, although they are a derivative of, you know, the holdings, let's say, underlying whatever asset you're using, but they do allow you to play mathematically to have the advantage of having a better odds in your favor. So what we did, that was yesterday, and I took a picture again this morning, and you can see all of a sudden the volatility, although it was an amazing day, and as you know, we went more than 2 standard deviation outside for Netflix. The volatility went from 82 to 54, and now you can see it's been going down, because now there is more certainty. We know what's happening, and because of that, volatility has collapsed. And if you'd like to see it visually, for instance, this is a chart of Netflix. This is what happened. If you recall, the expected move was about $33, and you can see, you know, almost 3 standard deviation. 3 times 33 is 99. We moved almost $86 in Netflix. But as you can see here, implied vol, every time there has been earnings, except this the March period, right in January, you can see the volatility goes up for the 10 to 14 days in advance, and then it collapses. It's every single time. So how can we take advantage of that? It's the third foundation I want to definitely understand, and you will make a lot of money if you understand the expected move, which is based on the implied volatilities, based on the probability. It is crucial to understand what are the market makers and option makers pricing into your holdings. So why expected move is important? It is just a random number? Is this a theory? No, it is not. And it's based on billions of dollars at risk within a real market. This is a real livelihood of a lot of people. So they work hard to make sure their numbers are within the reason, and that's how they price their options. So these option prices are based on supply and demand, and they are in real time, and that's why they become dynamics and they move. So I don't know if I've ever shared this with you. So here it is. What you see, basically all these numbers in the option pane and the charts that I've used, this is the formula for the expected move. 1 standard deviation move is based on the stock price times its implied volatility, square root of the days to expiration divided by square root of 365 days. So that's why you can see that's why the numbers change. So if implied volatility goes up, but the days actually less days, you can see, well, the movement could be up and down. So it's not just because the time is running out doesn't mean the expected move has to completely go down. It all depends on the implied volatility. So understand the expected move. Understand what is that 1 standard deviation movement. And you can always double, and that's your 2 standard deviation. All right, so let's talk about some strategies. I have like 12 or 15. I mean, we can have many hours. So I'm going to just offer you some of my suggestions. Some of them, again, the strategies you can study on your own, but some of the things that I refer during the earnings season could be profitable. And then I work on one specific one that I've used before, and I go more into details on that one. So one of the things you could do, you can buy it and strangle. And as you know what strangle is, we've talked about straddle, which works on expansion of volatility, but it is at the money. With the straddle, you buy a call and a put at the money. That means the same price. So we usually use, sometimes we use the Bollinger Bands, or we use a squeeze and Keltner channels to find, or even channels to find candidates for these type of movements. Strangle allows you to have a little leeway. So instead of having the same investment, same at the money option and call and put, you can go out of the money call and put. So you buy out of money put, out of money call. You obviously spend less on premiums, but also obviously you have a wider probability. So basically what happens is, in this situation, we talked about volatility. So one of the things you can do a week prior, sometimes I go 10 days prior, but usually there's something called Route 66. So it's like 6 days before, 6 days after. There's a strategy that we use. So let's say about 6 days, a week before earnings, what you could buy, you can buy and strangle. And why do we do that? If you recall, we looked at, as the time goes by around the earnings, the volatility, most of the implied volatility actually increases till the day of the earnings, or right before the earnings announced, which could be after hours or before hours. So a week before that, you buy out of money put, out of money call. I recommend to go way out of money, delta of 10 or 20. And why is that? Remember, when you are using, you want to, when the deltas, there's more volatility comes in, the delta actually increase and they expand. So we want to pay very little debit. So we go, although the odds are not in our favor, we just talk about delta being only 10% the chance it will succeed. What we are working on is the volatility. So this delta 10, it's very inexpensive option, but if the volatility increases, as you recall, has a positive relationship to the option price. So if delta goes up, option price will go up, or the implied volatility goes up, the option price goes up. So this is one of the ways you could do. You can buy really out of money put and call 10 or 20. And it is mainly, it's not the price movement, it's about the implied volatility movement. And what happens is, as a matter of fact, a lot of time implied volatility actually doubles right before the earnings. So what I would suggest, I would look into, if you don't make it, well, you didn't invest a lot of money and you let it expire worthless. So you're actually buying, hoping for the more expansion of volatility. But your exit will be, if your delta 10 goes to, let's say, to 30, then I'll be happy with that and I can take some profits. So basically you're expanding that the volatility has moved, your delta has made the option price going up. Or you can hold it till exactly the day of the right before the earnings. So if it's, let's say it's today, which is Wednesday, and earnings coming out this afternoon or tomorrow morning before the earn, then this will be a good time. We should have been out like this afternoon, for instance. So that's one simple strategy based on just the implied volatility increase. The other play you can do, you can play iron condors. With condors, now I would hope to you should refer to some of other the videos. It's the butterflies and condors, iron butterflies, and again, these are the basically, with the condor, with butterfly, you have one body. With iron condors, you basically have a wide wings. You have two verticals. And usually with this, your whole goal is looking at the expected move. So with iron condors, you can basically, your risk is very limited. It's defined risk. And basically, again, your whole idea is you want exposure to that volatility collapse because you're selling. So you want to make sure you collect as much premium as possible and you cover it after the earnings. So don't want to go too much in detail for this because again, you can study iron condors. I just want to give you the ideas for that. Let me work on some more other strategies. One of them would be, I mentioned with the strangle, but you can also do directional and can just buy a call and delta with about 2 weeks before the earnings and basically just wait for that delta expansion. Or if you're bullish or you're bearish, now you have a little bias, you don't really want to go and buy directional, just buy a call or sell. You can actually do, for instance, bullish credit, put spread you could do, or you can do bullish call spread. So you can make that, it's a limited risk again, and that one you have a little bias. That's another way of doing it, or like a Netflix. Imagine if you would have sold, based on expected move, you could have sold, let's say, vertical put spread. But that could be another idea. But these are, again, you have a little bias on these. Or you talked about buying at the money or near money strangle and straddles. This one is after the earnings come out. So what has happened is that we looked at the implied volatility going up. We get out right before it collapses. Now that the earnings are out, we have more certainty. Usually the markets really collapse, and especially out of money. And then at the money does go down, but not as much. And then what happens, you can actually start purchasing the day of the earnings. Now, when that complete collapse, usually sometimes even it's overdone, maybe you can buy strangles or straddles. Let's say today Netflix came out and it's done. Friday Intel has come out, or IBM. You can play actually, and that's what I mentioned about 6 days after. So you can buy straddle, strangle 6 days before, 10 days before, and then after the earnings can come out, it's all collapsed, then you can actually even try again, do it straddle, strangle, or a little movement to the back to the norm. Because based on charts, you could see there's a collapse and then it goes back gradually up. There's a few other ones we talk about, like a calendar strategy. And with the calendar strategy, what you could do is you can buy the near term, let's say this Friday's. Remember, the implied volatility goes up, but it collapses. So if you bought something, for instance, today, well, let's say it's for Intel tomorrow, what you could do, that the volatility is pretty high. That means the premium is up. So basically, in order to protect yourself, you can sell the near term, let's say Friday's option, which is really juicy premium, and then go ahead and buy the 1 week after that, which is at that moment, as you can see, that which we looked at, right a week after the earnings expiration, the volatility has collapsed. So the premiums are much lower. So this is called calendar. So you can sell the near term and buy the farther, and basically the same price. So if you're doing, let's say, Intel, just use $58 Intel, you can sell the 58 Friday, which is January 22nd, and buy January 29th. So that's another strategy you could use. So I want to go work with something that it has worked before for me, and it's basically taking advantage of the butterfly. And with this butterflies, one thing you have to remember in options are symmetric. So when there's a probability, if there's a high probability, there is a low reward. When that means, well, people who take low risk, but they have higher probability, then the rewards is not that much. When you take a big risk, the probability is lower. So if there is a 20% chance that you make big money, there's 80% chance you're going to lose that money. So not a lot, but if there's an 80% chance that you're going to make it, that 20% is not going to be as much. So you have to remember there's a trade-off of having a big payoff and a little payoff. So what butterflies do, butterflies, they, they give you a great reward, basically risk reward, but with a very low probability in a sense. So what happens is what is in a, as far as the butterflies, and so what, let me just explain what butterfly is and why we use butterflies. In this case, I'm going to use earnings strategy. I'm going to go in details with this specific strategy for earnings for now. But as far as when we use one of the strategies that we've used is the pinning Friday, for instance, right? So we look at where is the biggest activities, where is the maximum pain, let's say in the big stocks like Apple, for instance, or spiders, the ETFs we could use. We can, there's some stocks are pretty predictable. Netflix is not one of them, but like Nvidia used to be. And as I mentioned, Apple has been very good. Spiders are good. So if you see there's a huge activity on that, let's say, I just use random number like at 500, or let's say 100 on Apple, that $100, there's a lot of open interest. And the idea is they want to inflict as much pain on that, the holders of the buyers of calls and the buyers of puts. So basically they become the sellers. So the idea of selling options is you want to make sure you don't get there. So what happens is in this situation that $100 becomes that attraction. So what they want to make sure, they want to make sure, the option market makers, and they want to make sure that people who bought calls, let's say for 100, they want to leave, if it, they probably want them to be closed at 99.99 because they want to keep the premium. People who put the, again, if it closes at 100, the put sellers, they lost money too. So basically that's called pinning. So one of the strategies we've talked in the past is we can use a butterfly. And what butterfly is, you basically use that price, or we can use at the money. Basically you sell, in a sense, the straddle, you sell at the money call and at the money put, and then you buy higher call and buy lower put, in a sense. So you have these wings, call and puts, you buy these and you sell this. So based on that principle, what we're going to do, we're going to have a strategy for our earnings season. So let's see what our goal is. Our goal is we want to find using an expected move. And basically, let's say I will show you some example. And let's say in this case, we have used Intel. So you look at and you say the expected move is $3. So actually, let me go to the example and then we, so before I go to the example, I'll, first of all, I want to show you for our butterfly, and this is from Thinkorswim. Let's say you want to look for candidates for your earnings, and basically you want to find, and with the earnings, you want to make sure it's as short of a time as possible for our butterfly candidates, right? So what will you do? You go to weeklies because we want liquidity. So you go to the weeklies when you're screening. You look for the prices are more than $5 to $15. So you want liquid, but also you want to have something that, you know, it's not, you know, small cap or inexpensive. And then we look for earnings coming up in the next 4 days. So in this situation, we got some candidates, and one of them is, let's say, Intel. So we go back and we look at Intel, and we see, like, for instance, what happened the fourth quarter of 2019, and which happened in January. You know, they actually beat the earnings. And again, in this situation, you can see implied volatility went down. Not a huge amount, but it's still, implied volatility goes down. And we also look at, for instance, in this situation, we look at what is the expected move. So I have expected move of $3.73, for instance. and the implied volatility is at 92%. Look what just happened, right? It's 92% here. A week later, it drops to 59%. So basically what it tells us, it goes back to our calendar play, for instance. We could have sold this and bought this, for instance, just food for thought. So basically for a butterfly, we could actually, what we do, we go ahead and because going back, because the expected moves at $3.73, we're at 58.71. So I basically what I did, I thought around $62, for instance, $62. I'm a little bullish based on what I saw. I have a little bullish bias. So I choose the upper edge of expected move and I make that $62 becoming my body of butterfly. So basically what I'm trying to do is I'm hoping that it will close right around $62 in this area. So I will buy Friday, January 22nd, butterfly call, and basically you're basically selling two $62 calls. You're buying $60 call, which is in this case in the at that time still out of money, but you're using $2 spread. So you basically, your goal is to have by Friday, you want to make sure that your option will expire between $60 and $64. As close as to $62, that's your biggest payout. So basically, my debit is 23. I just want to use one contract so it's easier. So look what happens. I paid $23 for this debit. My profit is $177, which is the spread of $2, 62 and 60. There's a $2 spread, and minus the premium I paid. So this is a big risk. I mean, a big profit to risk payoff, right? So, but it is, the probability is pretty low. But then when it pays off really good. So with that in mind, I'm going to go back and let's look at the stages that we have to go through after my, and hopefully we'll understand how that works. So basically, again, the purpose is we want to have the option be as close to the body. In this case, is that $62, which is the central price. And we use that expected move as our really the goal that we have, that $62. So you can use this up to you, what wings you want to use. Usually $2 is the best. So your goal, and that's what I'm talking about with options, again, it's not something random. You want to do a little work. You got to do a little investigation. The goal is with this iron butterfly is the probability of success will fall between 4% and 21%. What that means is the probability of reward is, in this case, like 4-1, or it could be even 8-1. So, but that's how you choose your pricing and the spread. So in this situation, if you recall, we paid 23 cents. Our width of the butterfly was $2. So the probability of us winning this in this situation, this area we were bullish, winning this is about 11.5%. So why would we do this? Because we don't pay a lot of money, basically. It's only $23. But the chances are pretty good. If we made it, we get a big payoff on doing this. So you could go by a call option, basically. But again, that's just the random, and they're usually expensive. With this, you're collecting the premium, so it's very inexpensive. So you could, and this is how you can come up with, and I want to go on allocation. So let's say you want to do this strategy, but you say, well, you have to assume whatever you do, you're going to lose 100% because the probability is low, but the payoff is really good. So with this one, the position size, based on the experiences in the past, if you have a small account, 5,000 to 10,000, do not want to risk on this strategy more than 0.3 to 0.5%. So let's say 0.5% of 10,000. So you want to risk about $50 of debit, and you could have $225, or but again, the name of the game is you want to come back another day. So in this situation is $50. If you have a 10,000 to 50,000, you want a maximum you would put out is a 0.3%, which is $150 debit. And if you have account over 100,000, then you should do about 0.2%, which is $200 debit. Now, once you did that, you want to close this, before the expiration or hours before the expiration. And usually, again, most of the time they do go worthless, but expire. But it is, the odds are pretty good once it makes it the trade-off, the profit is pretty good. So that's one way of again, using some of these strategies. Now, one of the things is when you want to execute your trade, make sure we don't want, most of the time we don't want to do the market. We would do market if it's very liquid. Let's say we do not in butterflies, but let's say you just want to do directional. I don't mind like the spiders. You don't, 1 penny or 2 pennies is not gonna, affect you. But something like this, remember, in this case, you have 3 legs in a sense. So you basically you have the center, you have higher, and then you have in the money and out of money. So basically, what you want to do is want to make sure you get the best pricing, because you got to get in and hopefully get out. So in this situation, you want to go with the bid ask and try to put it in. And I would wait 45 minutes, and after 45, if it doesn't, I would just get adjusted, maybe pay a little more if I have to. And if not, I just let it go. But you want to get good pricing and make sure your trade is done correct way. You know what you are buying this spread. You're not selling butterfly, although you're selling the body. This is buying the butterfly, and everything is done. Now you want to closing the butterfly. You want to make sure it's close to expiration, and the greater the percentage return is when it's really close to that expiration. So our goal is to finish in that the body, and in this case, like we said, $62 body of the butterfly. And usually if it's the earning comes out, now it had to move, so you don't close it before the earnings, you close it after and close to the expiration. Hopefully if it's biased, then to the upside you had call. If you were negative, you would have done a put butterfly, but your goal is hopefully it will stay within that expected move, which is that 1 standard deviation. So we go back to our example again. So what we want to do is make sure that it is in a few days. It is, in this case, we have a little, as you can see, Intel has gone up in this situation. We have a little more positive bias on that. And we bought, again, this butterfly because the expected move was in 1 standard deviation was about $3.70, which is 62. So this is your body. This is the lower range. This is the upper range. And basically, this is expected move for this Friday, as you can see. This is the Intel's expected move. But if you recall, we had already a big move last week on Intel. So, and now the market is trying. So what I'm hoping is it will, when the earnings come, like somewhere around here. So this was done last Friday, and that's expected move. So let me summarize what we need to do. So in a nutshell, what we want to do for this strategy is first of all, any type of strategy you use, I really like to have stocks that they have weekly options. Number one, weekly options allows me to have more flexibility, a lot more uh, a lot more opportunities to play more, um, again, more trades. And basically, I don't have to wait for the month to come. And but also usually they're more liquid because it has to be, you want to have the most liquid stocks as your underpinning uh, option, because um, you don't really want to pay that big spread for bid and ask. So you want to have the most liquid. And when I talk about being liquid, that means you want to have, for instance, at least 1,000 open interests, especially in the near term, near expiration dates. So at least 1,000 open interests. You want to have hundreds of volumes in different strike prices. So you want to have that volume. You want to have a very small bid-ask price, because again, that's how it's actually it's taking profit away from you when you have a large bid and ask. So you want to make sure it's narrow, and again, you want to make sure it's weekly options. They are liquid. And now, for this strategy, if it's an upcoming earning is happening, make sure the earnings is, so today was the best day. So if you're using this, you want to make sure that there's not much time decay, in a sense that you don't want to have a long time left. So I like to have it either Wednesday, Thursday, or Friday. So I want to make sure the upcoming earnings are within next 2 days. So either they come after today's closing, or come before tomorrow's closing, or after tomorrow's closing, or before Friday. So whatever you're choosing, make sure the upcoming earnings are in the next 2 days. And make sure you have only 2 days till expiration. So if you were going to play, let's say, Intel, which is coming up tomorrow afternoon, I want to either play it today or tomorrow, because I'm going to use Friday's expiration. So that's why I always want to have very small. This is basically an expected move, and I don't want to pay a lot of premium. So basically what you do, you calculate the expected move. You look at what is the high of the edge, the low of the edge. We looked at the $3.70. And then you want to build a directional bias. The directional bias most of the time comes from actually general market, believe it or not. So if the markets are going up, usually stock, unless it's in a catastrophe or something, that usually they do have a positive directional bias if you're in a bull market. So you have a directional bias and use that. And then after you've done that, then you can determine the width. I use $2 in this situation. And how you can do that is finding the width. That's what you have to play around. And that comes to this 4.21%. You want to make sure you stay within that range. So if, for instance, if the debit I was paying for Intel was, in this situation, was 50 cents, and there's a $2 width, 50 cents divided by 2 is 25. That wouldn't work. I'm paying too much money for what I'm getting. So either I have to increase the width, so 50 cents divided by 3, if I went to $3 up, or maybe $2.50 up or low, 50 cents divided by 25 to 2.5, that's 20%. That will make sense. So again, there's a little work you have to do, but at the end of the day, it's all about the probabilities and also risk reward. And again, trade with what you can lose 100%. And then after you've done it, make sure you check to see that you execute your trade. So everything is correct because you have multi-legs. So with that in mind, I hope it was helpful. Again, there are like so many different strategies, obviously, but the main thing I want to emphasize is this volatility is the really important thing to remember, that the volatility expands, then collapses, expands. So any type of strategy that you're using, base it on that. Just because of it happens only 4 times a year, this because of the again um, because of the earnings. The only other times are when you work with the technology companies, especially biotech. Let's say they have a phase 3, they have the FDA hearing, so you will see that the volatility is off the roof till the again the numbers come out, or the FDA that disapproves it, or they come out with another phase. Then you see the volatility collapses as much as the stock really gets killed. So I mean, biotech is not my favorite option strategies unless you really want to do a directional. It's almost gambling. It's like a lottery ticket. Sometimes you can make a lot of money, and most of the time you lose a lot of money with those. But that's the only other times. But earnings are usually historically you can see it's based on really implied volatility. So with that in mind, it's almost 5 o'clock. So Sean, we can start recording and then we can open for the questions. And